I try to convince people to slow down AI, to regulate AI.
Of all of them, there's the debt growth that finances the bubbles that happen before it that create the busts.
Elon Musk and Ray Dalio, two of the best investors of all time, are in unanimous agreement about this one word:
recession.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go.
What started in America last year has now spread to every part of the world.
You're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
Now it looks like Fed Jerome Powell is leading us straight into a recession, possibly even at the end of 2022, if not 2023. We must talk about the inverted yield curve. That's going to be very important. He made some stark announcements today, which we are also going to cover here in this video. But first, we have to clear up the false stigma around a recession. Obviously, a recession is not good for everybody, but if you're an investor, you have an opportunity during a recession to buy cheap stocks, buy cheap real estate, buy cheap businesses. And actually, the most millionaires were created during the Great Depression than any other time in American history. So do not squander this opportunity. It might sound like there's a lot of fear coming out of my mouth, but I highly recommend you guys take this as encouragement. Well, the Fed came out today and said that you guys are now the bag holders. They are selling everything and they are off to their vacations. Not exactly what happened, but the Federal Reserve puts wheels in motion for balance sheet reduction. Minutes from the Fed's December meeting indicated that officials are ready to aggressively dial back policy help. One key aspect, the central bank's balance sheet, was the subject of extended discussion, with policymakers pointing to a reduction in bond holdings in the coming months. Members expressed concerns about inflation and said the job market is nearing full employment. Stocks slid following the release, while government bonds yield rise. Now, the way the Treasury has been keeping yields down, keeping rates low, is by buying all of these bonds. And when they are buying these bonds, they are not selling these bonds, so they stay on their balance sheet. What they are essentially doing is that they are stopping buying bonds with their tapering program that's going to be done by March. But after March, they're going to start slowly selling bonds. That's going to drive rates up. And they all of a sudden flipped a switch and are going super aggressive against the markets to try to tame inflation. I say that in air quotes here because they are trying to tame inflation. While the Fed already knows inflation in 2022 is going to be substantially lower than it was in 2021, why is this and how do they know this? Because the number one contributor to inflation is fiscal stimulus, aka giving out stimulus checks, giving out child tax credits, giving out basically free money to anybody and everybody. I mean, there was reports of dogs getting stimulus checks or people in prison getting stimulus checks. They gave away money to everybody. So of course, oil's going to go up in value. Of course, businesses are going to start raising prices, even though they didn't have to per se. But why not when everybody is flooded with a bunch of free money? Makes a lot of sense, right? If you're a business owner, can't fault them for doing that. But what is not going to be coming in 2022? Fiscal stimulus. What is going away in 2022? Monetary stimulus. Every factor that caused inflation is going away like that. It's gone. It almost instantaneously went away. Unemployment boost. Forgot to mention that. That was a huge form of stimulus. That is long gone. So when you add all of this together, why is the Fed really going super aggressive? Well, the Fed sees the economy in a different way than you see it. If you're invested in the stock market, you just want your stocks to keep going up, which is very reasonable. I think everybody wants their stocks to go up. But in the Fed's eyes, you can't have the stock market overly excited for a very long period of time. You need to go up and then come back down a little bit and then go up again. You need to see steady growth, not just straight up growth. And when the stock market's up over 100% in the last 2 years, it makes a lot of sense to start going super aggressive, to beat the economy into the ground, to cause a recession. So then you can come in and cut interest rates again and provide all of this quantitative easing to build the markets back up again. That might sound a little bit weird to you guys. I don't make the rules. That's just how the Fed operates. As far as this inverted yield curve, the inverted yield curve has predicted all recessions in the last 50 years. 9 out of 10 times in general. So with that in mind, an inverted yield curve is basically telling you we're going to have a recession here in the next 12 months or so. But I'm a strong believer that people with more money than us, than your average person, has more information than us. Because in fact, the yield curve inverted back in November 2019. The markets didn't crash until end of February, March 2020. So that was a good, 4 months before the markets crashed, the yield curve inverted. We have a lot of investors that are calling this out, like the bond king Jeffrey Gundlach. The yield curve may be sending a recessionary signal. If we do take a look at where the rates are actually at, the 10-year Treasury note is at 1.66%. The 30-year Treasury bond is at 2.07%. So the yield curve inverting is essentially if a 10-year bond or any shorter term bond is yielding you more than a longer yielding bond. So if a 10-year Treasury bond was yielding you, say, 2.5%, and a 30-year Treasury bond was only yielding you 2%, for an example here, that would be the yield curve inverting. The short-term bond pays you more than the long-term bond. That is a sign of economic growth is about to slow down dramatically, and we are heading for a recession. We are not quite there yet, but the point of this video is to say that the Fed is pushing us there. We're going to see dramatically less spending in the second half of 2022, and that is the number one cause of a recession, is consumer confidence going down, spending being reduced. I think we've seen the boom years as far as spending is concerned through all the inflation that we've gotten. Second half of 2022, not looking too hot. So what can you guys do about this? What is the point of saying all of this information is encouraging? Because it very much should be. Let me first point out that you guys are not normal people. A lot of normal people, especially younger, aren't really invested in the stock market. They might have their 401ks, their Roth IRAs, all of that good stuff, but they're not actively trying to make a large amount of money. If you clicked on this video, more than likely you're in that category of trying to make a lot of money. And recessions make millionaires. Every time there is a recession, more millionaires are created than essentially the last one. We add more millionaires to the world or to the developed nations. So what can you do about this? You can save more cash, which I'm not a fan of gold or silver or bonds. So you could save more cash. You could invest in defensive stocks, but have cash ready to go for when things do start to develop. I do think there is some more gains to come in the first and second quarter of this year. But by the third and fourth quarter, I'm going to be paying down all of my small margin account that I do have and be loading up more so on cash. That's going to be my plan. I also invest in real estate, so that is definitely a good sector to be watching, waiting for that to come down a little bit and to scoop up some cheap real estate when the deals do come on the market. As far as crypto is concerned, crypto would likely go down as well if we went into another recession. I don't think this will be a long-term recession. I think it would be a short-term recession, maybe 6 months, maybe a year. Hard to say. Predicting economics or macroeconomics is like predicting the weather next month. It's almost impossible to do, but that is the way that I am seeing the economy right now. Looks like we're heading into a recession here in the next year or so, and that is potentially how you guys can profit from it. If you're like me, you're probably just going to dollar cost average into your favorite stocks, because that is honestly the best way to play the stock market during any uptrend or downtrend in general, as well as, like I said, invest in real estate, possibly buy businesses if it ever were to get that bad. Don't think it will, but you always got to keep your options open. So that is going to do it for this video. Hit the like button for me. Consider subscribing to the channel as well. That's all. You guys take care. I'll see you in the next one.